Hi, my name is YoungKi. Over the last couple of years, I've been teaching two courses at the Construction Engineering Graduate School of Jungang University. One of them is Infrastructure Finance and PPP in the first semester, and the other one is Case Study on Project Finance and PPP projects in the second semester. I'm very pleased to invite and welcome all of you watching this video clip on the subject of assessment of project feasibility and bankability of infrastructure projects. In this lecture, I will address various issues unique to the development and the financing of infrastructure projects. Among many others, financial and economic aspects of project feasibility are highlighted as they are key concerns for decision makers in the public and private sector. In this regard, it is intended to provide you with basic knowledge and skills related to project feasibility studies. Particularly, special focus will be placed on the risk identification and mitigation embedded in an investment project. Furthermore, we will learn cash flow analysis and structuring of financial model necessary for making investment decisions and negotiating with lending institutions. This lecture note consists of four parts. First, assessment on the project's feasibility. Second, risk analysis, investment decision, and cash flow analysis. Third, project finance and bankability issues. Finally, a case study on coal-fired power plant in the Philippines, in which how risks are assessed and financially addressed. I hope you find it interesting. Then, let's begin with the introduction to assessing the project feasibility. Here is an interesting analysis on the major causes for project's failure. According to Standard & Poor's, the biggest contributor is market exposure, such as volume and price risk. Fuel hedge mismatch is also relevant to this factor. Technology and design failure, along with the cost overrun, is the second cause for failure. The other two major reasons are associated with structural weakness of a project, such as credit issues with a parent company or key sponsors, counterparty problems related to an off-taker, and breached government support not taking place as expected also contribute to project default with the same weight. So, from this analysis, I wonder what kind of thoughts you may have. For me, it is obviously the necessity for having a right feasibility study. This is why I want to talk about the assessment of a project feasibility and bankability as a topic for this open course lecture. Then let's see how exactly can a feasibility study help you with project preparation and eventually making a right investment decision. A feasibility study can be defined as a process to analyze and evaluate a proposed project to determine its technical, economic, and financial feasibility. But prior to undertaking a full-scale study, you need to start with investigating general investment environment, market conditions, and sectoral issues prevailing at the time. And you move to a next step for analyzing various conditions for the project, such as site survey, technical requirements, and commercial issues, so on and so forth. Based on these preliminary investigations, you narrow down to each of specific tasks needed for a feasibility study, starting from in-depth market study, cost estimation, subsequently preparing pro forma financial statements, including cash flows. Once you finish analyzing, measuring, and mitigating project risks, then you are ready to make a comprehensive assessment for the project. Now let's take a moment here to figure out the scope of a feasibility study. As any infrastructure project involves various stakeholders and relevant issues, its spectrum is actually wide and divergent. In terms of field practices, however, technical, economic, and financial aspects are considered most relevant than any other areas. So, we will focus primarily on these three scopes while trying to pay attention to the other scopes as well. For your reference, these practices prevail in finance and banking sector too. Surprisingly, I see not less people are confused with the result with the difference between economic analysis and financial analysis. So let me explain briefly before we go further. These two are different in many ways. First, the main objectives of the economic analysis is to measure how much social benefit of an investment will be generated from the national point of view. On the contrary, financial analysis focuses on the financial return from an investment. Due to these differing objectives and paradigm, measurement target and approaches are different too. In the case of an economic analysis, like mentioned earlier, social benefit on top of financial return is the main target for analysis, while in the financial analysis, cash flows in market terms are the target for research. Related to these externalities, such as health improvement and time savings, are included in the economic analysis. Most notably, discount rate applied for economic analysis is social discount rate, like yield rate of sovereign bond. Alright, then let's get to the main point of the financial feasibility study. The basic role of a financial analysis is to see if a project can generate enough cash for recovering investment proceeds and repaying debt raised for the project. Therefore, it is important to consider not only the size of an investment, but also the interest rate level and its impact over time, particularly for such a long-term investment as IPPs, short for Independent Power Projects. In addition, we need to understand the function of discount rate over cash flow in the form of financial ratios like IRR, internal rate of return, NPV, net present value, and DSCR, debt service coverage ratio. One more point I want to emphasize here is the fact that each stakeholder in a project, like investors, lenders, and the government, has their own needs for test ratios. For instance, equity IRR matters most to investors, while DSCR is important to lenders. This slide deck is about steps to take for conducting a feasibility study. Once a project is identified, then we should carefully investigate how much strong demand exists in the market. Then, it is necessary to establish basic premise and assumptions of the project for estimating cash flows. In cash flow estimation, there are certain set of requirements that should not be overlooked. First is to identify all relevant items in cash in and cash outflows. Then determine the timing of cash flows and measure the size of them. Also be sure to take into account uncertainties in each cash flow in terms of its monetary cost for mitigating risks. Once cash flow estimation is complete, then it's time to convert each cash flow into present values by applying appropriate discount rate. Then we can get financial ratios depending on the choice of analysis tool like NPV or IRR. Next step is to conduct a sensitivity analysis with varying scenarios, which is base case, worst case, and best case. This sensitivity analysis is practically useful for a comprehensive assessment and ensuing decision making as a final step of a feasibility study. In this second part of the lecture, I will briefly cover risk analysis, investment decision, and cash flow analysis. As you see on this slide, the risk profile of a project changes over time at each respective phase, while some risks prevail throughout the whole project life. In general, project risks grows to its highest level during the construction stage, and then this decreases significantly once the performance of a project becomes stable after commercial operation begins. In a PPP, public-private partnership, and/or project finance transaction, risk management is the key to the success of a project. In this vein, risk mitigation is at the heart of structuring a bankable PPP project. In reality, however, ways in which project risks can be handled are quite limited. There are some rules in risk mitigation. First, risks are retained by the public authority, which is quite uncommon. Or risks are transferred to and retained by the project company. In this case, risks are reallocated to third parties like an EPC contractor or O&M contractor. Or risks can be insured or having them guaranteed by sponsors. In risk transfer, risks are normally transferred fully to one side or the other. Second, risks are passed on a back-to-back basis to subcontractors who are best able to take certain risks. For example, completion risk is borne by an EPC contractor with excellent track records and financial soundness. Theoretically speaking, in the case of user fee-based concessions, risks can be transferred to end users through the project having a right to impose higher service fees. But it will be challenging as it requires consent from the contracting authority. Nevertheless, it is customary any residual risks are shouldered by sponsors unless the host government or other parties are willing to assume them. In this case, the financial impact of any risk which remains with the project company will be shouldered by sponsors. Finally, the manner of risk allocation, especially those borne by the project company, has to be agreed by the lenders. Also, any change in the project arrangement afterwards, which may impact the risk balance, is also subject to lenders' consent as well. In a process of due diligence, risk evaluation has to be undertaken by sponsors and the lenders throughout the bidding and negotiation phases. A key product of this process is a risk matrix or risk register, which sets out the nature of each risk and the effects, financial or otherwise, of the risk occurring. As you see here, project risks can be divided into a few broad categories. Under general phase, political or economic risks continue to exist throughout the project. During construction phase, there are risks related to the project site, such as construction and completion. During operation phase, revenue during construction, risks related to demand, network, service quality, and other factors leading to termination and related issues. In project finance, there are some basic concepts and terminologies indispensable in understanding financing infrastructure projects. Therefore, if you are not familiar with them, I recommend you study further than simply understanding the descriptions presented in this note. TVM, short for time value of money, means money today values less than money in future as their interest applies. Interest in this regard is like an exchange rate between earlier money than later money. It is interchangeably used depending on which side you stand. If you are a borrower, then it is called interest rate. You need to pay a bank. From an investing point of view, with that borrowed money, you should make more than interest payment per year. Then, in this case, it is called required rate of return. On the contrary, if you invest $100 today and earn $110 a year later, then 10% of return should be compared with the interest rate gain from a bank deposit. If your risk-free interest rate prevailing today is 7%, then you should discount $110 with 7%. So we say discounting applies to investing with your own money or borrowed money from somewhere. In that case, it will be 102.8, which is higher than 100. So the present value of 110 is $102.8. What is missing is risk premium, meaning that you may earn less than 110 or may get nothing due to risks occurring in your investment. Hence, adding risk premium, the required return for investment must be higher than 7%. This is the concept. Now let me explain NPV first. NPV, net present value, is the sum of present value of cash inflows and cash outflows over a period of time. To calculate NPV, you must use your expected or required rate of return, with which you discount all these cash flows to obtain present values. For cash outflows, of course, the sign is negative. On the other hand, IRR, internal rate of return, is the discount rate that makes NPV of an investment equal to 0. As you see on the slide, NPV at 16.13% is 0, which is equal to the cash flows that is applied for this calculating NPV. Discount rate below at 16.13%, such as 10%, NPV is 20,000 and vice versa. From this comparison, you can find the relationship between NPV and IRR, which is reverse. Then what should you do with these tools? If the NPV is positive, accept the project or investment. Also accept the project if the IRR is greater than the required rate of return. Whenever there is a conflict, however, between these two, then you should always use NPV, since NPV directly measures with ex ante rate of return the increase in value to the firm, without assuming reinvestment return would be the same for every cash flow over time, which is quite unrealistic in the case of IRR. Both NPV and IRR are used in an investment analysis too, in many ways, by various project parties. For example, the public sector uses economic IRR to estimate economic feasibility of a project, or to compare PPP project with public sector competitor for a public investment, as in many cases the government needs to pay service fee in many different forms depending on a project to a project company or an operator for an infrastructure facility to be built and run. Investors need equity IRR as a hurdle rate for an investment as illustrated earlier. Lenders also use the project IRR to calculate their DSCR and LLCR, short for loan life coverage ratio. Here are more basic terms that need your attention for cash flow analysis. First is current price and constant price. Current price is actual price you notice in the economy as it reflects inflation effect on constant price. On the contrary, constant price removes the effects of inflation. Therefore, using constant prices enables us to measure the actual change in output. Another important concepts related to prices are real and nominal interest rates. Like current prices, nominal rates include inflationary effects, while real rates exclude inflation. Thus, in applying discount rate for cash flow analysis, use real rates for real or constant price basis and use nominal rates for nominal or constant price basis. If this application is mixed, you will never know the real profile of cash flows due to different price bases with different discount rates. One more key concept you need to understand is associated with the cost of capital is WACC or WACC, short for weighted average cost of capital. WACC is, literally speaking, the discount rate reflecting the cost for both equity and debt, since a firm typically relies on both sources for raising funds. The cost of debt may be computed as an average cost of its debt from various sources, while the computation of cost of equity is complex as opposed to the cost of debt. The cost of equity is the return a company requires to decide if an investment meets capital return requirements. Firms often use it as a capital budgeting threshold for required rate of return. A firm's cost of equity represents the compensation the market demands in exchange for owning the asset and bearing the risk of ownership. The traditional formulas for cost of equity are the dividend growth model and the CAPM, capital asset pricing model. As we now have some understanding on the basic terms and the concepts, then I guess we are ready to get back to cash flow analysis. Needless to say, its role is to provide the investors and the lenders with information to figure out if cash flows from a project is sufficient enough for capital expenditure, O&M costs, debt service, and dividend payment to shareholders. In this respect, it aims to identify all variables and risk factors that may negatively affect cash flows and simultaneously quantify their impact on the financial performance of a project. The second objective is to address the varying needs of key project parties, sponsors, lenders, and host government by modifying cash flows with similar analytic tools and inputs. For instance, sponsors want to confirm the financial viability with return on equity, ROE, while lenders examine the debt service capacity of the project with DSCR. Usually, sponsors tend to have optimistic bias on the project's outcome as feasibility studies prepared from their own perspectives. Then let's take a look at what the main components of cash flows are from an infrastructure project. Cash flows can be seen from the direction of cash movements, that is, inflows and outflows, as you see them on the slide deck. Another classification is based on the phase of a project, construction and operation. Of course, at each phase, there are both inflows, such as equity injection, drawdown of debt, revenue, and outflows like development cost, EPC cost, tax, and the debt repayment. Next item that needs our attention is a financial model as an essential part of cash flow analysis in a feasibility study. It basically requires a lot of Excel worksheets with macros, pretty much mechanical process. However, it certainly requires students to understand the basics of finance and business rationale of a project in question. As you noted from the previous slide, cash inflow and outflow items, along with macroeconomic indices, are recorded in the corresponding worksheet of Excel for calculation. Then what you get from the model as outputs are financial statements along with various financial ratios. Well, this slide looks a little bit complicated, but in fact, it's not that difficult, as a matter of fact. As indicated earlier, three major project parties are investors, lenders, and the government. And these three parties respectively require a certain financial ratio type to test if the revenue from a project can meet their own internal criteria. As these parties are basically different in the role and the objectives participating in a project, the cash flow to which they pay attention is different. First, capital cash flow is a free cash flow to creditors, also known as CAFDS, short for cash flow available for debt service, which is a source for debt service, literally speaking. Thus, it is used to calculate DSCR and LLCR. The computation is as simple as that you add depreciation, as actually no cash outflows took place except that it is just recorded for an accounting purpose. By the way, the starting point is always EBIT, earning before interest and tax, for all three different cash flows as you see on the slide. Then deduct CAPEX, capital expenditure, and add net change in working capital. Finally, you deduct the corporate tax by applying tax rate on EBIT and add back tax saving on interest expense. This interest tax shield added back indicates this cash flow basically assumes the debt component as a part of capital structure of a project. The second category of cash flow is called free cash flow to equity, or simply equity cash flow, which belongs to shareholders. Equity cash flow is the basis, therefore, for return on equity, or equity IRR, calculated by simply deducting corporate income tax, and treat interest expense as cash outflow by not adding back as interest tax shield. Then you add only the net cash change in debt, that is plus new debt minus debt repaid. Since equity cash flow includes debt as cash inflow and interest paid as cash outflow, increase in debt raise return on equity. The last one is called free cash flow to the firm, a basis for ROI, return on investment, which shows cash flows generated regardless of a capital structure of a project. Free cash flow to the firm reflects only the deduction of corporate income tax, but without adding back the interest expense, as it is unleveraged cash flow, assuming there is no debt raised for the project. Therefore, high ROI means the project's revenue provides a stable debt service to creditors, while shareholders can expect high equity return at the same time. Furthermore, within a certain range of ROI, both creditors and shareholders struggle to maximize their own pie of interest. Now let's move on to the part 3, the project finance and bankability issues. This diagram depicts the relationship of different financing products in a capital structure of a project in terms of their risk and return and the role in an investment. Equity providers expect unlimited upside potential for their investment, while are willing to take the risk of losing all invested proceeds in case of a project fails. As they have to be responsible for day-to-day operation, in other words, management control, based on their equity, they are entitled to hold ownership and voting rights. In this regard, investors are junior to senior lenders for the claim on cash flow and residual assets. On the contrary, senior debt is financing obligation that holds legal claim to the borrower's assets above all other debt obligation. This means the senior loan or guarantee is considered the senior in the event of a bankruptcy. The senior credit is the first to be repaid. Because senior bank loans are usually secured through a lien against the assets of the borrower in case of a default, the assets used to secure the senior bank loan must be used to repay the senior bank loan before other creditors, preferred stockholders, or common stockholders receive any payment. Mezzanine financing is a hybrid of debt and equity financing, and is subordinated debt or preferred equity instrument that represents a claim on a company's assets which is senior only to that of the common shares. Mezzanine financings can be structured either as debt, typically an unsecured and subordinated loan, or preferred stock that gives the lender the right to convert to an equity interest in the company in case of default, generally after venture capital companies and other senior lenders are paid. Now it's time to see what project finance is and why it is used in public-private partnership. Project finance is a specialized financing instrument for financing long-term infrastructure projects like PPP, industrial projects, and public services using a non-recourse or limited recourse financial structure. The underlying transaction is typically a standalone project with SPC, Special Purpose Company, as a borrower. Unlike corporate finance, it allows high debt ratio as the debt is expected to be paid back from the cash flow generated by the project. Projects suitable for project finance has finite project life, unlike corporate loans where debt may be rolled over indefinitely. Lenders in project finance rely primarily on the project's cash flow for repayment, with the project's assets, rights, and interest held as secondary collateral. Therefore, it is called contract-based financial engineering. Adding a few more words, this diagram illustrates key differences between project finance and corporate finance. As you see here, typically in corporate finance, the parent company either becomes a borrower based on their own credit standing or collateral. Or even when a project company is a borrower, it provides assurance for repayment by its subsidiary through corporate guarantee or standby LC from a creditworthy bank. In project finance, as explained earlier, there is no credit enhancement from the parent company except typical sponsor support commonly found in project finance, because the project itself is considered having enough capacity to generate sufficient cash flow for that service. Therefore, the project company becomes a borrower to lenders who provide debt financing to the project based on the project's commercial viability or bankability. Let's talk about bankability requirements of a project finance. No matter how a project might look profitable from a sponsor or developer's viewpoint, if it is not considered bankable or financeable by potential lenders, then you are not able to get needed debt financing, since it is obvious that the whole project cost cannot be entirely funded by equity. It is going to be very expensive and least profitable in terms of return on equity. This is what bankability means, and there are at least three key elements that you need to pay attention. The first is the country for a project's location in terms of political risk, economic conditions, investment environment for both foreign and domestic investment, legal and regulatory framework, and prior track records for identical or similar private investment. The second element is the characteristics of a project, like how strong demand exists in the market, technical, environmental, and social feasibility, estimated cash flows from the project for that service, and so forth. And the project's contractual structure and its participants, in that how risks would be allocated and what kind of value addition could be provided in building and operating the project, is also critical to the success of a project. Finally, sponsor is a key driver in the success of a project, as it should be the last resort for any residual risks, not to mention being an entity responsible for ensuring technical, commercial, and financial feasibility of a project. In this regard, the track record, intention, experience, and financial strengths of sponsors are key considerations for lenders. In addition, the composition of sponsors to a project is another important factor in their roles and responsibility in a project. Here's the Cebu coal-fired power plant case project, with which I will show you how the feasibility study was utilized, examined, and challenged by both investors and lenders. The coal-fired power plant, as opposed to other types of conventional power generation, has unique risks due to its fuel and technology. Among many other risk drivers, the heterogeneity in a coal type like lignite or sub-bituminous coal, creates complexity in technology and in environmental issues. They require greater capital expenditure as it needs additional equipment with advanced technology. Furthermore, it is subject to rigorous regulation and higher challenges in securing needed financing because lending institutions are required to maintain higher environmental standards for their lending business. This project is located nearby Cebu City in Cebu Island of the Philippines. It has 200 megawatt generation capacity using circulating fluidized bed boiler technology to burn imported sub-bituminous coal quality. The project is structured in a way to allocate various project risks over project parties with differing roles through various project contracts. In this project overview, we will find the key components of this project ranging from sponsors, site, contract type, project cost, and contractors. To be short for key items, such as sponsors, KPHI is a subsidiary of KEPCO in the Philippines, and SPC is a local private utility company. One of the highlights of this project is the fact that there is no official PPA, power purchase agreement, as the generation sector of the country was liberalized earlier before this project began. So PSC, power sales contract, was agreed with 9 electric cooperatives in the region, meaning that there is a significant level of revenue risk along with uncertainties associated with these 9 ECs, and these uncertainties create the potential problem for debt service capacity. Again, part of coal supply was sub-bituminous quality through coal supply contracts with Indonesian suppliers with limited tenure. These conditions brought about two significant risks. One of two is technology risk associated with key equipment and the supply risk related to procuring enough coal at least during the maturity of that financing. Finally, the country risk for the Philippines as of 2009, when the project was under development and initial discussions with the lenders were taking place, and particularly for commercial lenders, the country risk of the Philippines was a key concern, as it was indicated by OECD country rating, fourth ranking out of 7, and BB- by Standard & Poor's, both of which represent underinvestment grade with substantially high political risk. On the financing front, the high equity ratio, which is 40%, reflects certainly these potential risks of the project that I mentioned a second ago, which are revenue risk, fuel supply risk, technical risk, and political risk. For that reason, international commercial banks participated in this project as a covered lender, required financial guarantee from Korea Exim Bank to ensure recovering their loans in case of a project default. Certainly, without financial support from Korea Exim Bank and Asian Development Bank, the project would not have succeeded in securing needed debt finance. It is very clear, furthermore, both Korea Exim Bank and Asian Development Bank, along with international commercial banks covered by the financial guarantee, were very instrumental in identifying and mitigating key project risks as pointed out, eventually leading to a successful project finance showcase in a developing country. Now, I would like to conclude this lecture by summing up key principles in project finance and the assessment on the project's feasibility. First and foremost, accurate demand estimation is essential as a prerequisite. Second, be sure to set out most realistic assumptions for key parameters, and at the same time, try to avoid any bias, optimistic bias in particular, on the results. Third, stay focused on the business rationale and key drivers for an investment, as you can be immersed in an analysis for the sake of the feasibility study, missing the fundamentals of the project. Fourth, meticulously identify and analyze risks, and also quantify the cost for mitigating these project risks. Last, but not the least, sensitivity tests on cash flow must be as much rigorous as possible, since lenders and other project parties will not accept the results if they are not completely convinced. So this brings an end to the lecture. I appreciate for your keen attention. Thank you very much again.